Good afternoon, Marty and everybody. Jennifer, you don't mind, since I think you have the most substantial, I'd like to put you in the middle and start with Leif and then end with Elliot. Is that okay?
Sure.
Okay, so what we're going to do is we have Jennifer Warren, Concept Elemental. She's a writer. She's an academic. She understands the energy transition. She also understands energy. She's in Texas. She will be our middle speaker. We'll start off with Leif Klakken, the chairman of the board of Ghost Fishing. He comes out of northern Norway. And we will finish with Elliot Trexler, who runs a hedge fund for Global Return Asset Management, which is he's done some work with the UN and sustainability goals and protocols, so that he is a ESG hedge fund of sorts, and he'll get into that. But
I want to mention, Tyson,
interesting story, and we're going to have him start. And Leif, why don't you?
Tyson, I just wanted to mention
about 10 minutes. We'll take some questions, and then we'll go to Jennifer Warren, who will speak for 15.
And Tyson, I just wanted to mention that I have never even heard of ghost fishing until this week. So it's an amazing topic. Leif, define ghost fishing.
Yeah, thank you, Tyson, and thank you, Martin, for inviting me to this panel. So my name is Leif Martin Klakken. I'm one of the co-founders and chairman of Ghost Fishing Solution. We are a tech company dedicated to addressing the global issue of ghost fishing. We're providing the fishing industry with a tool to prevent loss of fishing gear. But my career has spanned across various sectors, including insurance, banking, and for the last 15 years, I've been in real estate. We sold our student housing company to a US fund called Heitman earlier this year. That gave me the opportunity to invest in Ghost Fishing Solution full time. So growing up on the northwest coast of Norway, the ocean has always been an important part of my life. I've spent countless hours fishing with my father, primarily for cod, lobster, and stone crabs. But a few years ago, we lost a fishing net. It's valued around $2,000, and I started searching for a solution to prevent gear loss. And this was, of course, from an economic point of view. But I didn't find any suitable solutions for it. So learning more about the issue and the impact of lost gear and how it impacted the ocean health, we understood this was a huge global issue. That led us to creating Ghost Fishing Solutions. So ghost fishing, it's a term for lost fishing gear. It's nets, lines, pots that continues to catch fish and other marine animals. So the term ghost fishing comes from lost fishing gear that keeps on catching, trapping, and killing wildlife for years. We know that some studies have shown that this fishing gear, that it takes 600 years to decompose. And when it does, it breaks down to microplastics. And as you may know, microplastics then enters the food chain. In addition, ghost fishing has a huge impact on marine life, but it also destroys the natural grazing, including coral reefs, because the seabed itself, it absorbs over 10% of the global CO2 yearly. And now you know that ghost fishing is a huge global problem for the environment, but it's a huge global problem for the fishermen, because 2% of all fishing gear is lost every year. It's not abandoned, it's lost. And that represents, on a global scale, $10 billion. And as well, the fishing gear, they lose the biomass in the fishing gear, and that represents $20 billion. And most of the fishermen are searching for the gear, and that represents $5 billion. So At Ghost Fishing Solutions, we developed a tech. It directly addresses the issue of losing gear. And then the problem of ghost fishing. This technology, it doesn't only aid preserving the marine life and our CO2 absorbers, but it plays a crucial role in mitigating plastic pollutions in the oceans. Quickly, try to explain how it works. Our GFS here is mounted beneath the buoy. In case where the buoy is damaged or the fishing gear drifts off and goes deeper, we have a communication device in the GFS. It releases due to pressure, and up to the surface floats the communication device. This will send a push notification in the app, an SMS, an email to the fisherman that your gear is drifting to deeper ground, so you have to come and get it. So the business model. Our GFS has a subscription business model. Our clients only pay $99 a month with a 3-year binding period. For us, the cost for 3 years, excluding shipping, is $200. The revenue for the 3-year binding period is approximately $3,500. So we have developed this tech with the fisheries in our local communities, and we've been talking with fishing companies in the US, and we have developed a standard model. But the tech is scalable, so we can do a more Arctic extreme version, and we can go down to a lighter version. So the market, we've been working with B2B market. For the B2B market, it's important for us that they have a product that have value for them on itself, and the ESG is just an added value to the product. We've also been working with a couple of NGOs to building a partnership for less developed countries. Now we have, hopefully we're doing a deal early next year that will give us the possibility to deliver up to 100,000 units in this market. So the market on a global scale is based on the number of commercial fishing vessels. This market represents 20 billion in size. Our expectations for 2030 are 5% of the market. That represents a yearly revenue for $1 billion. And there are some already players in this space. The preventive market is small. And for the few who have released the product, they are not in our competition at all, because we are the only product that truly delivers a preventive solution. So I just want to sum up. This is basically an Apple AirTag for your fishing gear. We are a tech company that prevents loss of fishing gear, but that also prevents marine litter and damage on the largest CO2 absorbers we have. The unit has a subscription model. The product have value for the fisheries itself, but ESG is an added value, of course, and it's recurring revenues. For now, we just started with our Series A funding. We are pre-revenue. We are launching the product first quarter next year. And we are looking to raise $14 million. That's on a convertible note. You see that the investment will be used to protect our patent and establish globally sales offices, establish our partnership with World Wildlife Fund, and also the production of the gear. We have been working with some US-based tech companies like Good Machine out of San Francisco, and we're 100% sure that we will start the production early next year. And with me, I have Inga Rönnbäck. She's the CEO of the company and also one of the co-founders. Herman Helgesen is the engineer and the tech side of it. And also I have Bør Andreasen, who is the marketing guy in this company. So if you want to gain a deeper understanding of our project, don't hesitate to contact us, and we'll be happy to provide with more details.
So how much have you raised to date?
For now, it's been self-funding from the sale of my student housing company. So we spent approximately $2.5 million so far from my money. So we haven't raised anything.
So do you have a prototype device, or you've been marketing device, or?
We have an MVP, and we've been working testing for the last 14 months. And now the whole production line is set. All the tech is ready. So we've been sourcing all the suppliers and everything. And we're just ready to start production and launch for next quarter.
Does this gather data and send it to the cloud?
Yes, sir. It's a lot of big data here. And we are also providing the client with information like weather, waves, and all these things, but we're also collecting big data.
Of the 2% of fishing gear that is lost, how much of it is commercial versus retail?
This is only based on commercial. So we have no good data on the private market. So this is only based on reported commercial fishing vessels.
So
and
most commercial...
We're not talking about discarded gear. We're only talking about lost gear.
And are we talking only about ocean gear, like, gear that's lost in the ocean and seas, or not lakes, correct?
Oh,
or rivers?
Not lakes. Primarily only oceans, yes, not lakes and rivers.
Right. So all of these fishermen are licensed by international federations, right? All commercial fishermen. Yep. Why wouldn't they just make it that you have to have technology like this?
That's the thing. This is, if you guys have been following the COP28 and all the debates around legislation, we know this is a mega trend. It will not be free for all to put fishing gear in the ocean in the future. But if we're going to have a head start on this, the fisherman needs to see the value in rescuing the gear, because the ESG side of it just added value for now. But in a few years, we know this will be 100% sure that it will be due to the UN and everyone working on this, a legislation that says that you need some kind of security for your gear. But until that happens, we need to provide them with a tech that they see the value in based on the economy itself.
And any questions here about those fishing? It's an amazing story. Great. I don't see anything from the audience, so Tyson, I think that you can move on.
Well, I got
fantastic,
a question.
Leif. Yeah. I
got a quick question. So you're convertible for $40 million, did you say?
Yes, sir.
What kind of coupon is associated, and if it's fully converted, what kind of equity stake in this business does that result in?
So for now, our pricing on the investment, it's based on a estimated subscription of 12,500 units. That's our estimation for the next 2 years. And for the 14 million, we're expecting it to convert to 10% of the company.
Where do you manufacture the device?
What does the convert pay in terms of interest?
One more time.
What does the convertible pay in interest?
No, it's for now it's 8%, okay. And then it converts to a 25% discount.
So where is it manufactured?
Right now it's all Norwegian, but we're working to establish the company with a US holding company. And we're looking at Mexico and we're looking at US.
What's the duration of the sales cycle?
So for now, it's economically lifespan of 3 years for the unit, the binding period. But we are expecting the life cycle to be 10 years for each unit.
How long does it take to sell one?
As we're working with NGOs that will give us huge volumes, up to 100,000 if we get all the deals signed. But we're also working with larger fisheries. So we're not selling one unit. We're selling it in bulk.
Perfect. Tyson, back to you.
Well, I think that's great. It reminds me of Ed Yardeni talking about the innovative character of America, and we'll include
Absolutely.
Northern Norway as well, in terms of coming up with creative solutions and how this happens in environments which are not communist. Anyway, our next speaker is Jennifer Warren, and she is a expert in finance, global economics, and sustainability. She understands the energy space very well. She's located in Texas, went to London School of Economics, and has a variety of credentials. She served as the CEO of the Dallas Committee on Foreign Relations for a while and is well connected. She's going to give us an overview of what this ESG 2.0 or the energy transition looks like as we end the year, particularly with COP28 having just completed. Jennifer, tell us what's going on in the world as we make it a better place to live.
Well, I may disappoint you on the COP perspective entirely, because I'm going to go by the numbers. So just to start, so I've been to 12 conferences this year, and Economist Conference, blockchain summits, Federal Reserve Bank energy conferences, which was actually one of my last conferences. And it was the Fed districts of the 10th and 11th districts, which is Kansas City and Texas Feds, and it's a $4.5 trillion economy, and a lot of it driven by energy. And so what I'm going to do, though, is just sort of break this down, what's kind of going on in respect to fossil fuels, gas, renewables, and then my sustainability projects I'm working on in particular. So on the fossil fuel crude oil side, first of all, right before the pandemic, the globe was consuming about 100 million barrels a day. And in 2023, it's back up to 102. It hasn't gone down in spite of everything that we hear and hope for. And then it's projected to rise to 103 or 104 million barrels a day, depending on whether OPEC is right or the US EIA is right. The United States is producing like 13 million barrels a day from only 4 million barrels a day 20 years ago, and that is largely because of shale. And that's something that I've been chronicling for the past 20 years. I started with all of the early shale developments and have followed that. The other number I'll throw out, this is by Bloomberg, is that as of May, the United States produced almost 16% of global oil production as a country. In Saudi Arabia, it was like 12.5%. And just to give you the numbers, so that industry, oil and gas, will spend in CapEx about $560 billion this year. Now, back when net zero and ESG really came in the forefront and we really started talking about going to net zero, like the 2017s, 2018s, fossil fuel CapEx went down to like under 400 billion a year, and which was, not sufficient to supply what we are producing now and consuming as a globe. Now, on the COP28 side, the good news is 50 oil and gas companies that represent 40% of global oil production have pledged net zero. But a lot of the big majors and US independents, a lot of them had already pledged net zero. But what's different about this COP is that you have more national oil companies, a la Aramco, and the OPEC, NOx, China pledging net zero. Now, all those aren't necessarily in the 50 that I just said are pledging, but it's movement forward, and it's, again, there's a lot of wiggle room in this as well. There's a lot of loopholes in this COP agreement. Just a number two, like I said, this is a little bit by the numbers on some of this, but this gives you a sense of what is reality. In the United States, we drove 270 billion miles. During the pandemic, the very low point, we drove 170 billion miles. So it has gone right back up where it was before. Now, in the future, some of that will be defrayed by electric vehicles, so we'll get, some less tailpipe emissions. But everything I've seen, any projections have been like, you could get 10% EV penetration, maybe 20. It's going to take a long, long time for that, frankly, just because of the minerals requirements, the infrastructure requirements, the investment rationales, all of it. And then now let me switch to natural gas. On the natural gas front, so on fossil fuels, natural gas is really kind of where a lot of action is. It's going to be, increasing demanded by the rest of the world, needed to be sited alongside renewables for baseload, unless you have nuclear or other renewables for now and for a while. The United States is one of the largest natural gas producers in the world, producing about 110 BCF this year, and we export 13 billion cubic feet, and we're going to add 10 billion cubic feet of LNG exports by 2027. We have saved Europe because of our LNG exports when they had to cut off their pipeline imports from Russia owing to the invasion of Ukraine. So what this has done is it's the onset. When Russia invaded Ukraine, it was really the onset of a global gas market, whereas before it had been more regional blocks. So it's changed the calculus to a large degree. And I had written about it in 2022 in an article called Solving Europe's Energy Crisis. So if you want the data, it's in that. And just to note, we just started exporting LNG in 2016. So it's quite the feat that we are about to export up to, 25 BCFs a day in the next, handful of years. That's really amazing. And one of the experts at the Fed Energy Conference just noted that because the US is now exporting LNG, we have added depth and liquidity to a market that did not exist before. Yeah.
Jennifer, quick question.
Sure.
I don't want to get caught up in jargon, but BCF is billion
cubic feet. Yeah. Billion cubic feet. Yeah. Yeah. Million barrels crude, billion cubic feet. That's how those look. And again, we're a low, we have lower prices than anywhere in the world on our natural gas. Also, we're exporting like 5 million barrels a day of crude, whereas crude oil was banned from being export in 2015. So this is rapid, exports of fossil fuels on our side, which really speaks to our capital markets and our infrastructure. And then on the clean side of gas, a lot of the oil and gas firms have pledged to, have negligible methane emissions up to 2030, and they will be verifiable. So just to note that. Now, on the renewables side, which gets to the grid, and this is where it gets complicated, and Texas is a total petri dish for all of this because we're the largest oil and gas producer, and we also have more renewables on our grid than any state in the country. So just renewables are to grow at a 35% per annum, rate, I think, to 2030. There's a lot of headwinds to do with critical minerals, grid integration, capital competing with higher IRRs in fossil fuels. But the grid challenges are really notable in Texas. And we have some, a day ago, I looked at the ERCOT grid just to see. We used 50% renewables in our power generation. But we have the capacity that's 2 and 3x that in renewables, meaning there's a lot of capacity that sits on the sidelines, and that is cost. And in Texas, we have some new things developing called demand response. And one of the demand responses to help smooth the fluctuations in the grid owing to renewables are Bitcoin miners. I spent a day at the Bitcoin mining stage, and it's an energy story because they use a lot of energy, as will AI, as will quantum computing. So that is also a headwind for the grids. It's not going to all be met with renewables. There's going to have to be greater density to support all that increased computational power and all the electricity that is being demanded in the United States and around the world. So there's going to have to be some base load. The other thing I will talk about is, and then the other, just to note, I did a video after the Fed Energy Conference, and it's called After the Fed. It's the last one I produced. It's on my YouTube channel. And I have some slides that relate to the things I'm saying about the grid. I do get more nitty gritty into what's happening with something called, with solar in particular in Texas, because there's so much solar power. It's called curtailment and congestion costs. And it cost our grid and our state $3 billion last year. So, we're having to work that out. And that's where the Bitcoin miners have come in to kind of soak up some of that excess capacity that we have. They're doing it through, like there's a decommissioned wind farm somebody's in the screen. Somebody's like right in the, there's a decommissioned wind farm and a Bitcoin miner set up and recommissioned the wind farm and is using the power from that. So there's a lot of really interesting, innovative solutions happening in Texas because we have a really pretty free market in power compared to other markets per se. And then the other thing I will talk about is with fossil fuels on the ESG side, there is a huge efficiency push, and we're going to be seeing more enhanced oil recovery, of course, CCS, and that's something I've dug into quite a bit, and I have a lot of videos with experts on that. So I've really been, listening to and working with some people on the cutting edge of shale tech, fossil fuel efficiency tech, and that sort of thing. And so, which has to happen because fossil fuels are still going to remain more than 50% of the usage around the world for some foreseeable time. And this is largely driven by developing world demand growth.
Hey, Jennifer, I got to interrupt you again.
Yeah.
So this is kind of like a multivariate equation because cars and other vehicles for transportation are getting more fuel efficient. Right.
Absolutely.
But the demand for petroleum products in things like beauty and things like clothing, etc., just keeps on going up. Right.
It's a wash.
There's a deficit. I am the number one proponent that all hydro energy in the United States will cease to exist within the next 20 years. Why? Because we're the worst country at maintaining infrastructure. Just look at that dam that collapsed a couple of years ago, caused all these deaths. Anybody from New York knows the roads are always bad, right? So, and they're outlawing it in the West, right? So California, Oregon has outlawed hydro. Washington State is likely to outlaw hydro for the same reason, which is salmon migration. And California is running out of water to have hydropower.
Right.
As a matter of fact, California has shut down more hydropower, has lost more hydropower than it has gained in renewable energy since the push for renewables since 1995.
Yeah.
So to me, it's like there's still going to be huge demand for carbon-based fuels.
Oh, absolutely. You cannot get away from it. It is a complete false narrative to think we're kicking fossil fuels. We're nowhere near it, and it's only increasing. Now you can get it, at a plateau at some point, but it isn't happening now. You might see it with oil at the end of the century, 2030s. You could see that, but natural gas still grows. So now, yeah, sure, we can have some breakthroughs with fusion and fission for baseload and all that, but that's going to require different infrastructure. And getting to your infrastructure comment, and then I'll switch to my special ESG projects. The U.S. hydrocarbon infrastructure system is a complex, very expensive legacy system. And I just spent a lot of time, I'll show you this, actually writing about it and researching. And this is because of chronicling the shale booms. You had to connect all those basins with midstream infrastructure and pipelines to get it to work. And things had to be re-engineered even. And it was tens and tens and hundreds of billions of dollars of capital to make that happen. That is a completely underappreciated story. And I wrote about it. I don't know if you can see that. It's called The Pipeliner's Dream. If you want to Google that and read it, and it'll give you a real update on all that, connecting the shale basins in the United States and who did it. So to my ESG sustainability projects that I work on. So within my firm, I have something what I call
Hey, Jennifer, can I just jump in one more second here?
Sure.
And so I'll tell you where our thesis comes from on sustainable energy is that we had InQtel present in 2007. And there was a big push even then for wind and solar. And their presentation was that, well, the problem is that the best wind is not where any population centers are.
Right.
So it's impossible to transport that energy.
Yes.
And the problem with solar, of course, is the base load is rewiring the wires to be able to transport solar, back into the generation centers, right? Because it's a one-way direction. And that was 2007. That hasn't been resolved yet.
No, well, and so funny enough, in my last video, I have slides showing why this is the case, in fact, and you'll see it in a graph with 3 lines, and what it's called is the duck curve. And that is because when you solar, you're catching it when the sun is shining, and power demands are highest from 6 p.m. to like 9 p.m., like 8 p.m. is the sweet spot. So the sun's not shining when you need it. But natural gas follows the curve. Wind is a different story. If you look at these charts towards the latter part of this video, you'll just get it in a snapshot, and you'll be like, oh my gosh, that's the problem. And that's the challenge, And then, so to move to my,
we have one more question, Jen. I'm sorry to keep on stopping you.
Sure.
Well, I think the hydrogen, converting solar and wind into essentially hydrogen and then transporting the hydrogen to them, not turning that to electricity at that point and moving it to different centers could actually be a very good solution. And that's what the global view is. And I think California is trying to build, for example, lots of solar, turn that to hydrogen, bring it to the cities, not to put it in cars, but there's a lot of other industrial use. So we're working on it, for example, a fuel cell for ships, for liners. So I think, you just have to be aware of there's a whole spectrum of solutions coming up that, all these renewables are effectively can feed into it. So that's essentially the right battery.
Was there a question in there?
Yeah. What do you think about that?
What do you think about that?
Okay, so here's what I'll say about. Okay, I know what he's getting at here. I will answer the question really quickly. And so I've looked into hydrogen. I talked to people about hydrogen. Hydrogen's very specific, context specific, great in hydrogen hubs in industrial centers on the Gulf Coast. There's going to be applications, sure. it is an enormous water and energy hog to do hydrogen. You are talking parasitic energy loads to do it. And I'm not going to go into the deep weeds about all of it, but that's just the high level, just, talk about it. It will happen possibly over time in certain ways. Niche for now.
We have
Niche.
another question. Jen, I'm sorry, but you just create this whole thing about you. So.
It's okay.
Yeah, hi Jen, Jason Ma. I assume that you are much more knowledgeable than I am when it comes to alternative energy. What about next generation nuclear energy?
Yes.
It's hydrogen.
Yeah.
China
No.
is way ahead, strategy
Yeah.
building.
No, absolutely. Small scale nuclear modules, absolutely. That's going to happen, has to happen, because we have to have the base load, and renewables can't get you there around the globe. There's not enough minerals in the world. There will be too much conflict over it. There already is. Look at the supply chain reworkings. China is decades ahead of us in processing minerals in the renewables push, in the EV push and all that, but also they have they're not a capitalist society, right? This is being pushed from the top down. So that's the other thing. But yeah, nuclear's, on the books, and it will happen more. But I just wanted to quick talk about something that's a real true ESG project. If there were one, this is like the real deal ESG thing. So I have what I call a natural capital practice, and it's taking sustainable projects. I do it from an advisory point of view, and I've developed a network, and 2 of my projects are ranches in the panhandle of Texas. One of them is an 80,000 acre ranch, and it is like 2 centuries of this amazing environmental record, like pioneering in wind, water management, agricultural practices, all this. Huge historic legacy connected to Native Americans, which is the S part, right? Homage to all that. And then the G part is that, in fact, so this ranch, the Turkey Track Ranch in the Panhandle, was developed across 3 centuries. And in the last century, in the 20th century, for the last 75 years, women have been largely responsible for growing the land acquisitions of that ranch and monitoring them since the Depression and after World War II. And there are like 3 women that sit on the board governing the operations of this ranch, and it's a really amazing asset. And I'm part of the team that's the transition team, helping to identify a new steward for this like really amazing asset. And then my other project is a 10,000 acre ranch where I've looked at hydrogen, I've looked at solar, wind, digital infrastructure. We're trying to lay on all these different revenue streams to make it kind of like a sustainable ranch for future generations. And so I've been in the weeds even with all these energy fuel sources as well, seeing what is economic, what is doable, and so that's the way I test myself, even with the trends analysis, is, what does it look like on the ground, but just in a summary way, I would say that I would characterize the energy transition as an absolute mashup. There are centralized and decentralized approaches happening at the same time. Now, centralized approaches, of course, is, the grid and, fossil fuels, oil and gas, those are of scale, right? And then the decentralized approaches where we're seeing hydrogen, more niche applications, microgrids, things like that. So you see a lot of it, a lot of variation depending on, which country, the regions in the country, depending on how big the country is, policy, financial resources, and physical natural resources. So it's just a real mixed stew. That's my solution.
Thank you, Jennifer. That's great. Do we have any last questions? And then we'll go on to Elliot Trexler at Global Return Asset Management.
I had a question about Venezuela and whether they're going to do an invasion of their neighboring country or not. Guyana.
Well,
Guyana, right?
Yeah, no, I haven't followed the politics of that. I understand. I mean, Guyana is, you know, Exxon's there and Chevron's there, and there's a lot of oil wealth. I don't see how, frankly, they could get away with it.
There's a 200-year dispute.
Yeah.
And Britain signed an agreement that they would discuss the dispute in the 1960s. It happens that the disputed land is actually where they just made the largest find of oil in the last 20 years in South America.
Well, what I can say, because here's something important, is that, and this is something that was said by like the chief economist of ConocoPhillips, and this is obvious, but it's really interesting when someone else says it, is that, you know, volatility and geopolitics are going to drive what happens with fossil fuels and crude. You know, it just does, right? Look at what happened with Russia, you know, so that's always the wild card. And it is why fossil fuels always have a volatility element to it. But with renewables being added to the grid, they are adding volatility to price as well. So this is the brave new world we're in.
Well,
Which I think is a great
Jerry. That's
preface for, this is a great preface for Elliot's discussion. So
Elliot Trexler, you're the Chief Investment Officer of Global Return Asset Management. I understand you have a hedge fund that has returned gross around 28% for 11 years. I think I did a little back of the envelope with a 0.5% management fee, 15% carried interest. That's around a 23% net return over 11 years is great, but you apply a variety of ESG protocols so that you're not investing in un-ESG type investments. Tell us about your fund and how you run it and the ESG element or overlay you employ.
Yeah, sure. First of all,
you got 8 minutes.
Pardon me? Can you hear me?
You got 8 minutes.
8 minutes.
you sound
okay.
great. We'll actually, we'll give you, well, no, you've got, I'm going to give you 10 minutes.
Well, I
Very
appreciate
generous.
that. Anything more than 3 or 4, you all start to doze off. So I'll keep it short. First of all, thanks for asking me to speak, Marty. I appreciate it. As it relates to ESG, I was on the PRI committee. There were about 50 of us from around the world who wrote the suggested guidelines for the hedge fund industry to incorporate ESG factors into the investment processes, So I've been incorporating ESG since since our inception 11 years ago. And I'll talk more about that in a second. Regarding global return, we have one fund. We're a small partnership, family and friends. I own 99% of the company. We are registered minority with New York State, New York City. The fund is long only, and we hedge with options and inverse ETF. We hold a concentrated portfolio of US listed stocks, 25 stocks or less. And then I want to be very specific on our return. That is our risk-adjusted return, and that removes the effect of our cash balance and hedges. So that is our risk-adjusted gross return, and that's how me and our LPs, that's how I and our LPs look at it. It's our return on risk, our return on investment. Starting here in a couple months, in Q1, we are launching a second fund. It's a very different strategy from our existing strategy. It'll be long only. It will have 75 stocks, no hedges, no cash, 100% net exposure. It's fully automated. We're using advanced technology to identify the stocks. And those stocks are selected based on their corporate fundamentals. This is not a reversion to the mean or technical type strategy. The benchmark in universe for that fund is the Russell 3000. And this is back tested over a 16-year period. Our results are very robust and consistent and far surpass the Russell 3000. And again, we're launching that in Q1. I've recruited a great group of high quality, impressive people, and really looking forward to launching that. Please contact me if you'd like more information.
Elliot, can you explain what fully automated means? Does that mean you're not making decisions, but the automation
Correct.
is?
Yeah, correct. And it's the turnover is based on calendar period, not there's not active portfolio management. It's about 100% turnover.
Is this an AI based or machine learning, or what is it exactly?
So to be there is no machine learning involved, and you know, AI is, I think, one of the most grossly abused terms on Wall Street. Everything's AI. In the sense that it's automated, there is some artificial intelligence that happens, but I don't want to oversell what this is in terms of AI. Yeah. So as far as ESG goes, we are not an ESG fund. I want to be very clear about that. The way that I approach ESG is it's a way to identify risk within a company. So we know that corporate financial statements do not have a line item that say risk. If you're going to find risk within a company, you're going to have to look within its operations. And there are multiple operations that are required for a company to operate. ESG just happens to be one of those. So let me give an extreme example to highlight my point. If you have a company and part of their operations is dumping toxic waste or disposing of toxic waste in a local river, they're going to get fined. And that's an expense for environmental degradation. That financial risk is not ever going to be listed on a financial statement. It might be listed buried in the footnotes if there's like pending litigation or government enforcement action. But absent that, you're going to have to look at their operations, which would include this dumping, to identify, okay, there's an ESG factor here that could ultimately be very risky. So that's how we approach ESG. It's really a way of identifying risk. I guess the other thing too that I want to highlight on this is, so we have different models based on the company. This might sound obvious, but I'll just use, again, an extreme example to highlight my point. If, for example, I'm going to analyze Facebook or Meta, as it's called now, I'm not going to analyze their how they handle package waste. They're not in the business of distributing products which have a lot of packaging waste. Conversely, if I'm going to analyze Walmart, which obviously distributes and sells millions of packages, it is worth looking at what is their policy and procedure in dealing with package waste. A good example of that is they did this several years ago, maybe between 5 and 10 years ago. They went back to all of their suppliers and they said, we need you to cut down on your packaging by 15%. That's great for the environment, but it's also great from a profitability standpoint. That's less plastic, less cardboard that has to be manufactured. It also cuts down on cost of goods to produce and distribute these products. And importantly, it frees up more shelf space for Walmart to sell more products. So that's how we look at ESG factors is, again, how does this company operate from an environmental standpoint, social standpoint, governance standpoint? And is it an effective way of handling their ESG practices? Again, I'll go to the extreme example, dumping waste versus cutting packaging by 15%. And could this ESG practice lead to making money or losing money in the form of fines? So I can get more detailed and specific if you'd like, talking about materiality and so forth, but with a short period of time, I'll stop there.
Any questions here from the audience? I mean, I think it's very interesting. How much capital are you managing right now?
The existing fund is 40 million, and we have 15 LPs, friends and family. And
is that purposeful that you've kept it so low?
have spent 5 years developing the technology and algorithm for Fund 2. And if I had my choice to either market or spend time with my code, I'm going to spend time with my code. And so
It doesn't talk back.
the few LPs that we do have, again, are family and friends, and they're literally people who picked up the phone and said, Elliot, we'd like to invest. And that's really how, again, there's 15, maybe 18 of us.
What's the capacity of your strategy?
Fund 1 or Fund 2?
Both.
Both. So Fund 2 is enormous. When I say enormous, 5 billion. And we are targeting a couple $100 million launch. We're still settling on that based on the conversations with our anchors. Or in day one investors, but at least 100 million. And for the existing fund, I'm pretty focused on Fund 2. I'll just say that. So it would have to be a special, unique situation to bring in capital for Fund 1.
Fantastic, great. Well, great job, guys. Thanks so much. Tyson, any additional comments?
No, I think it was a great job. Thank you, Jennifer, Elliot, and Leif.
And
And
again,
Marty.
you guys are good. By the way, you guys are good friends of mine. So happy holidays. So thanks so much, guys.
Thank you.